All right, I think we're ready, getting ready, get started. So let's get it. All right, thank you for everyone for joining us for Dartmouth Investment Financial Review Program's second annual stock pitch competition. For a quick introduction, my name is Yizan. I'm one of the co-presidents of DIPP, and I'm joined by Geoff. He is one of the investment committee members who heads the stock pitch competition event. We're representing this DIPP, which is Dartmouth's largest undergraduate organization, focused with 150 members on pre-professional career focus, whether that's finance, investing, or software engineering. We sort of do it all. At its core, we are an investment fund managing over $700,000 of Dartmouth's endowment, but we also supplement Dartmouth's liberal arts curriculum by providing pre-professional programming for campus at large.
We're thrilled to see the extensive participation in By the DIPP this year, with students participating from Hanover to California to Montreal, London, and Hong Kong. We had over 800 participants this year, representing over 90 schools, with more than 150 teams submitting a pitch deck. And as our contestants know, we also hosted a tremendous amount of coffee chats for students at schools across the board, connecting with numerous professionals at our 11 sponsor firms. We wanted to thank everyone who participated for your amazing hard work in your submissions, and we really appreciate your support of our second annual stock pitch competition. We hope that everyone had a fun and enjoyable learning experience. And today we'll be wrapping up our competition. We have 4 teams competing in our main final, as well as 5 in our freshman showcase. We're thrilled to see a lot of the underclassmen participation in this event, and we hope that our competition has provided an opportunity for you guys to learn and get feedback. And of course, we have over $6,500 in prizes that will be distributed to our finalists and freshman showcase teams, and we're really pumped for the pitches to come.
Yeah, we also wanted to thank the support that we received from Dartmouth at large. So one of our sponsors, also partners at Dartmouth, is the Magnet Center for Entrepreneurship at Dartmouth, which we became a partner with this very year. We want to give a huge shout out to Sarah Morgan, one of the facilitators at the organization, who has helped us so much with the partnerships, partnering with firms, getting the allocated funding, as well as just generally logistics aside. We also want to thank David Russ, who is on this call. We'll introduce him a little bit more in a bit, but he is one of the final judges, and he helped create DIPP back in 2006. So we really wanted to thank him for all the help along the way, both facilitating this event and creating this organization all the way back almost 20 years ago.
Next, we'd like to thank our 11 corporate sponsors: Advent International, Apollo, Bain Capital, Bridgewater, Citadel, CD&R, Fidelity Investments, Morningstar, Morgan Stanley Investment Management, Warburg Pincus, and Tuck Advisors. These partnerships would not be possible without the tireless work of our alumni and friends at these firms. We're really grateful for the guidance and help, and we think that it's a testament to the strength of the alumni network that are able to come together and in support of our mission here at DIPP. And we would also like to thank DIPP's alumni board, a network of alumni representing previous DIPP members dating back to 2011, who have continued to provide guidance and have seen the organization evolve and grow over time. Additionally, we want to acknowledge our semifinals judges. We'd like to thank Brandon Chen from Centerview, Tench Cox from Crown Advisors, Tim Tsui from Altamont, Liz Kinsella from Advent, Kira Kohler from KKR, Alex Payne from Morgan Stanley Investment Management, Zach Port from Blackstone, John Song from Advent, and Megan Wu from PJT. Our semifinals judges were really crucial in the success of this competition, helping narrow down the 16 semifinalists to the 4 that we'll be presenting today. And we think that the experience for the teams would not have been at all the same without them being there to judge and provide feedback and critiques. And last but not least, we'd like to thank DIPP's investment committee and the other presidents, Connor, Ane, Zen, and just the leadership at large for the help in coordinating these pitches, grading them, and helping to select the semifinalists.
So now we want to introduce the judges for the finals. So we are honored to have three top investment professionals really judge these pitches. Starting out, David Russ, who's on the call at the moment. He is a senior advisor currently at Angelo Group, focused on climate change investments. But previously, he was a chief investment strategist at Credit Suisse Asset Management Group. Formerly, he was also a chief investment officer for Dartmouth's endowment, as well as UC Berkeley's endowment. We are also joined by Pranay, who is a research analyst currently at Fidelity Investments and help manage infrastructure funds at Fidelity. Previously, he was at the University of Pittsburgh. And lastly, we wanted to introduce Rebecca, who is currently a principal at Skylight Capital. Previously, she was at Goldman Sachs Investment Banking Division, as well as Private Equity Division. And she was at Dartmouth 16, who was a part of DIPP's investment committee. They'll be judging the final four teams, which is Instar Group, which will be pitched by Axel, Alexander, and Jacob. Altus Power, which will be pitched by Claire, Sam, Avijit, and Hein. Lastly, there will be judging also SSR Mining, which will be presented by Anika, Neha, and Nayantika. And then as well as CROX, which will be presented by James, Tyson, Ludovico.
We'd also like to introduce the freshman judges. The first is Alec Schaefer. Alec is the vice president of Morgan Stanley Investment Management and a portfolio analyst on the broad markets fixed income team. He joined Morgan Stanley in 2021 when it acquired Eaton Vance, and Alec began his career in the investment management industry in 2017, where he worked as an analyst focused on investment technology. And second, we have Drews Wirtz, who is currently the head of AI at Tuck Advisors and an independent machine learning and AI consultant. He held previous roles at Tiger Cubs, such as Hoplite, at Caxton, at the original Tiger Management, and at Salomon Brothers in the 90s and 80s, working as a technical lead and a macroeconomic analyst. And he graduated from Columbia in 1986. Lastly, we'd like to introduce our freshman showcase participants. The goal of this round is that, well, whereas most competitions throughout the country typically only run one competition, we wanted to give freshmen the chance to showcase their abilities and really get exposure early on in their investing careers, get feedback from these professionals so that they can grow and improve as they embark on the rest of their college careers. And we're really impressed by the work presented here and are thrilled to be introducing these 5 teams who each have at least 2 freshmen among them. So first we have Ahan, Eric, and Ryan from Dartmouth, who will be pitching Danaher. Second, we have Aaron, Arelis, Nandini, and Jando from the University of Houston, who will be pitching Vaxite. Third, we have Jake, Ameya, Arnav, and Tejas from Dartmouth, who will be pitching Snowflake. Fourth, we have Mihir, Madeline, and Ben from Columbia, who are pitching Occidental Petroleum. And finally, we have Drew, Solomon, Philip, and Dylan from UPenn, who are pitching Janus International. And yeah, thank you guys for participating. We're really excited to see these pitches.
We'll be getting started at 2 p.m., but just wanted to say once again, we really appreciate everyone for joining our event. It was over 150 pitches submitted, definitely had a long timeline. So we appreciate everyone's hard work and joining us to learn a little bit more about the top teams in the nation and what they've come up with for stock pitches. So we hope that you can stay with us for the entire 2 hours. We'll be getting started at 2 p.m. So we'll be taking a short break to get the teams ready. If the teams can make sure that all the participants are online, so we can make sure we can give you all panelists permission as soon as possible, that would be great. But everyone will be meeting back at 2 p.m. to get the judging started. Thank you so much for joining us and see you guys soon.
All set?
Yep.
Perfect.
Go for it.
Yeah. So first of all, we want to thank DIPP and the judges for making this final happen. We are from Lund University, and today we will be presenting Instar Group as a long recommendation with a target price of $599 out of 2025, equivalent to an upside of 127% and an IRR of 49%.
So Lund University is in Sweden, in case that wasn't clear. Now, what is Enstar Group? Enstar Group is in the business of assuming runoff insurance policies. They aim to settle liabilities at a gain over what it paid to assume them, and to earn investment income on the float generated in the interim period. Setting liabilities at a gain is effectively negative cost debt that Enstar utilizes. The company has grown book value per share at an above 15% rate since its inception, but despite its track record, the shares currently trade at below book value at 0.8 times book value, and insider ownership is high at over 10%, which mitigates the black box risk that is inherent of most insurance companies. Our thesis for Enstar is threefold. One, that its runoff earnings are better than most fear, and two, that Enstar will earn a higher return on its equity from higher interest rates, and three, company has previously had several non-core divisions that has masked profitability in recent years. Recent divestments of these non-core assets should allow people to more accurately see Enstar's underlying great returns. We believe that this opportunity likely exists due to a confluence of factors, including limited coverage, as Enstar has zero sell-side research despite a multi-billion-dollar market capitalization, a pretty low float, and a lack of like peer, as there's no other publicly listed runoff company. And these all contribute to making Enstar an odd and overlooked security.
Yes, runoff is a necessary part of the insurance industry. Insurers could continue to manage discontinued policies by themselves, but they often dispose of them to runoff specialists due to several factors. Firstly, managing claims from runoff portfolios is a non-core activity for insurers. Runoff specialists can manage portfolios more efficiently by aggregating many similar lines. Secondly, runoff is a tool that provides insurers liquidity, risk management, and release of capital. Lastly, it is challenging to motivate employees in an insurance company to manage a portfolio that is inherently shrinking over time. Importantly, this means that insurers are motivated sellers, enabling runoff specialists great opportunities to generate high returns. The runoff market has seen steady growth, growing an average of 8% between 2010 and 2022. The current size of the market is $10 billion. This figure is expected to increase as insurers have recognized the value of disposing of runoff portfolios. Competition within the industry has started to intensify around 2017. One could believe this would impact Enstar's ability to generate high returns, but this assumption is incorrect. Competition has most notably increased on smaller deals, around $100 million in size, whereas 85% of Enstar's deals are larger than $450 million. Pricing on larger deals has not meaningfully changed due to three reasons. Firstly, regulators prefer proven players to acquire large portfolios. Secondly, the market is very relationship-based, where repeat transactions are common. Lastly, supply is also increased, making the pie larger for all. I would really here like to emphasize the bottom right graph. We note that competition has significantly decreased in the last 18 months, with new entrants receding from the market due to losses brought about by undisciplined acquisitions. This provides a more attractive environment for Enstar going forward.
Yes, we want to quickly go over how a runoff transaction works, economically and from an accounting standpoint. Simplified, when Enstar acquires a set of insurance policies, it records liabilities based on the seller's expected ultimate loss, even if Enstar expects its own losses to be lower. So $100 of acquired liabilities on the balance sheet will over time become 90 as Enstar works through the claims. Importantly, this means that Enstar's recorded book value is understated by 10%. Claims that are settled at a discount produce earnings. Earnings are counted as a negative expense, and we call such earnings reserve gains going forward. There are two common runoff transactions, a loss portfolio transfer, LPT, and an adverse development cover, or ADC. In an LPT, a portfolio of liabilities with asset matching it is assumed by Enstar from an insurance company. Usually, Enstar will assume losses up to a risk limit, reducing tail risk. An ADC is a regular reinsurance contract where Enstar covers any excess losses above a pre-agreed amount. And once again, I would like to emphasize that Enstar's book value is understated by approximately 10%.
myself. So we want to quickly go over the advantages that Enstar's competitive position gives them. So first of all, their high returns is a factor of that they have regulatory barriers that favor them and other large incumbents. Namely, this is seen through reduced capital requirements that the large carriers receive, allowing them to deploy less capital and earn higher equity returns on the same deals that smaller players wouldn't be able to do. And secondly, and specific to Enstar, there's a pricing discipline ingrained in its company culture that has shown to be very significant over time. They only make 2 to 5 investments per year, but they analyze those deals on a claims-by-claim basis to ensure that all risks have been uncovered. And when we use data from Enstar's loss triangles, we see that this advantage has over time given them an analyzed reserve gains of just below 2%. And we believe that much of their success can be boiled down to this pricing discipline. And thirdly, this sort of highlights part of that pricing discipline and their experience. Looking at workers' compensation is a specific platform at Enstar where they have received very strong recognition of being best in the industry and has therefore overperformed the industry by a mile. We think, again, that this is a clear example of their success. Now, over to our first thesis point, which is quite simple, even though it requires some explaining, is that the earnings figures that Enstar reports from reducing their liabilities is declining as a percentage of their total liabilities. So earnings seem to be in a downtrend, and it's easy to believe then that there's a causal relationship between the increased competition that we talked about and the lower returns that we're seeing. But when we revisit that graph, I've put it on here again, showing Enstar's reserve gains by acquisition year, you can't really see a trend of declined profitability. So what explains all of this? Well, earnings in any given year is a composition of reserve gains from many years back. Specifically in this case, the earnings contribution from deals that Enstar made in 2007, 2008 have historically been very high, as those deals were extremely profitable. On the lower half of the slide, we observe a very strong relationship, or correlation rather, between runoff earnings as a percentage of total liabilities and the pre-2013 vintage contribution to profits overall. The decline in earnings then simply reflects the seasoning of their old, extremely profitable vintages. And these no longer have an impact on the results. We see that 95% of reserve gains in the last year were composed of newer, specifically 2013 to 2022 vintage developments. And so because of this, we know that returns are not actively getting worse and should stabilize at the current levels as they have done for the last 10 years.
Yes, this brings us very nicely into our second thesis point. Enstar's investment returns have been depressed due to an abnormally low rate environment. However, this is imminently about to change. Enstar primarily invests its float in safe, short and medium-term securities. The recent surge in interest rates has yet to be reflected in Enstar's earnings due to the lagging effect of fixed maturities. Enstar's current book yield is almost 150 basis points lower than the Fed funds rate. This gap is expected to close and turn positive within the next 2 years. The associated increase in profits are expected to increase return on equity by 400 basis points. I would like to highlight the top right graph, where it's noteworthy to us that Enstar's book multiple has yet reacted to higher rates. We can see that Enstar is previously in a higher rate environment traded at 2 to 3 times book value.
Yeah, so over to our third thesis. Over the past 5 years, Enstar has divested several non-core operations and is now solely focusing on its core business. These ventures historically weighed on Enstar's results, sometimes impacting total ROE by as much as 600 basis points. The proceeds from the divestitures have partly been allocated towards accretive share buybacks. Only in Q3, Enstar repurchased 5% of shares outstanding, and additionally, the CEO increased his stake by 7% in a transaction worth of $10 million. Since 2021, the company has repurchased a total of 29% of its shares at prices below book, highlighting management's commitment to creating shareholder value.
Over to perhaps the most important question, what is Enstar worth? Well, the shares currently trade at 0.8 times price to book multiple, and that's after we add back mark-to-market losses on its bond portfolio. To get to what we seem as a fair book value multiple, we have a few return on equity scenarios that we outline. In our base case, we assume a pre-tax return on equity contribution from the runoff side of 4%, and that's in line with the 5-year average that we previously went over, we believe should be stable going forward. We then assume an 11% pre-tax return on equity contribution from the investment side, and that is derived from the 4.4% blended return on the portfolio itself that we then lever up to their leverage ratio. I would highlight that this yield is just a little bit above the US 10-year, so it's not very aggressive. The final output of a 14% return on equity easily justifies in our mind a 1.4 times price to book multiple, which would result in a $599 share price by 2025. And another way to value Enstar would be to just view it as a levered box of assets, generating a seemingly average cost of capital return. This would put Enstar at its closest comparison to peers, as the industry overall is barely profitable on its underwriting side. But to do this, we need to reduce the company's liabilities, as we mentioned how its book is understated due to the fact that liabilities are overstated. And Enstar doesn't incorporate any of its accretive value drivers on the liability side. And when we then reduce those liabilities that we know that they'll be able to reduce by, let's say, 10%, which is a little bit below their historical, they've been closer to 14% average, then equity value is closely boosted by 2 billion to 1.5 to 2 billion, and that results in a tangible book value of $480 per share. If we grow this book by 10% per year out to 2025, we're getting close to our original share price target. We get to 590 in book value relative to our $599 share price target. We feel pretty confident that this valuation gap will close, partly due to the accretive buybacks and the insider purchases, and partly because of the higher earnings figures that they will report in 2024 and 2025. But if you want to look at more of multiple spaces, we have a few other ways to look at it. We can see that historically, this is from Arch Capital 2021, that Enstar has received pretty high returns with low volatility. And this, when combined with the next slide, has been something that the market has given a lot of value to when it comes to other insurance companies. So we think this is instructive, that other companies with this higher of a return trade at 2 to 3, even 4 times book value. And we think Enstar might not get a 4 times multiple, but definitely higher than 1 times.
Yes, I'd like to end us off with a few risks and a catalyst. The 2 main risks we see in our investment are, firstly, the risk that a poor deal would blow up the balance sheet. This has only impacted Enstar's earnings once in its 25-year operating history, but it was no significant damage. Management's alignment with shareholders mitigates the risk, and Enstar also completes all runoff deals through subsidiaries. Secondly, higher medical cost inflation could increase Enstar's future liabilities, but there's no indication as of right now that medical cost inflation is accelerating. If we move on to a catalyst, we note that the P&C market has hardened significantly, as we can see in the bottom right, since 2020. A hard market will increase returns for insurers, leading industry participants to bring their underperforming portfolios into runoff to invest capital into higher return opportunities. Enstar should benefit from the increased supply of runoff portfolios. Thank you very much for listening, and we're happy to answer any of your questions.
All right, thank you so much. Judges, if you have any questions, feel free to open up.
I'll kick off. Thank you guys so much. What a choice. Reinsurance. Not a space I spent time in, but this is very educational. I just want to talk like first principles about what you think the 3 things are that this business needs to do well to succeed. And then I'd like for you to line that up with like performance historically along those vectors and what could change that fact going forward. Like what are the 3 things this business needs to do in order to perform well, in your opinion?
Yeah, I'd like to take a stab at that first, and my teammates can follow up. I'm going to go back to, I think, our first thesis point. We have a graph that showcases what I believe is the most important thing. Underwriting is very important, because what we've seen historically is that runoff companies that have not succeeded, and there are plenty, they usually underwrite one or two bad deals that blow up. It's a 100% increase in liabilities than they expected. And when they've taken an outsized deal relative to their equity capital, that has been disastrous. So looking at Enstar's last 10 years, which is not an overly sort of positive period for that, for their history, we see that they have earned or sort of reduced liabilities, so forth, earned sort of a return that way in every single year except for 2020. And so we believe that's a very significant sort of signal of their underwriting capability. So I would like to add that as the most important factor of them all.
Yeah, if I could add shortly, I think, discipline and patience has been one of Enstar's strongest, greatest strengths historically. And if I attack the historical question, we've seen that since the early 2000s, Enstar has managed to grow its tangible book value per share at an over 15% rate for now a bit more than 20 years, which we find very impressive. And they remain disciplined throughout the whole period, which I think is very impressive as well.
Yeah, that goes into talent and sort of talent retention, which is incredibly important, because that is sort of what allows your underwriting over a long period of time. And there we've seen through a few sort of calls that we've read from previous employees and so forth, and the co-founder of the business actually, that they have had a very robust C-suite team, and people in the industry, if you look at industry publications like Insurance Insider and so forth, they talk about the robustness of the Enstar talent team, and how a lot of people in the industry are moving from one place to the other, but Enstar seems to retain their employees really well. And so that's something we've noticed that we think is important.
Okay, great. I'll ask one follow-up and then kick it to the other judges. So you guys say underwriting, discipline and patience, and talent retention. I want to ask about a fourth that came to mind, and if you could just comment on, businesses like this, like a Barkel, Berkshire kind of business model, you need to minimize losses on your insurance portfolio or try to eke out some profitability and then go earn money on your float. So one piece that I would assume is really important for this business is that they invest that float profitably in a disciplined manner. So can you talk about, seems like historically they've been underperforming the market, why you view that as potentially changing moving forward?
Sure, that's actually a very great question. It's something we thought long and hard about. And what we realized after, reading a bunch of what industry professionals says is that there's a very big difference between a company like Enstar, Catalina, and National Indemnity at Berkshire Hathaway. That Berkshire Hathaway's primary business is to reinvest and invest the float over a long period of time. They don't really work down the liabilities quickly. Well, the core difference here is that Enstar really tries to work down the liabilities as quickly as they can. So they don't really try to get any excess alpha on their investment side. They really just, do A-rated bonds, basically very conservative portfolio management.
Yeah. So when we say underwriting, or when I say underwriting, I also sort of include that liability management, because for them, reducing those liabilities is the key. And I think they realized pretty early on that that's what they're good at. So they always focused on that and just outsource investments to an external manager and do that very simply.
Okay, cool.
Thank you. This is Dave. I have a few questions. Can you hear me?
Yep.
I'm just going to ask my questions so they're not sequential. First one, unfortunately, I know a little bit about this business. I was offered a position with Jack Byrne back in the 1990s to manage the Fireman's Fund portfolio, which he ended up going to Geico and joining Berkshire and then forming White Mountains. So I'm a little bit dangerous, but essentially, is it a runoff portfolio forever? I mean, as long as this policy is in place, that's question one. Is Enstar purchasing new runoff portfolios from other entities? It would seem to me they'd want to diversify and keep the flows available. And then one of you mentioned that the losses in the bond portfolio had an impact on the share price. Now, shouldn't that continue as interest rates are lowering? I would think that would hurt them still, so that's not off the table. And then on your very first page, you talk about expected return of 121% and IRR of 49. There it is. I'm wondering how you projected IRR. IRR is a very tricky calculation. It can be manipulated. Just one example, I had a venture manager who had a 78% IRR in 18 months, and he ran out of capital, and he wanted more money. And I said, wait a minute, I would have preferred 35 over 10 years. He didn't get the math. So I'm curious about your use of IRR and how you derive that. And then I have a recommendation for everybody to read a paper called You Can't Eat IRR, excuse me, I'm getting over a cold, by Howard Marks, M-A-R-K-S. He's the founder of Oaktree and a friend. And it's a very interesting paper because it talks about that 78% problem. If you have a big hit early, you can actually go to market with it. So that's not what you're doing, but I'm curious about your IR calculation. I'll stop there. Thank you. But by the way, great presentation.
Thank you very much. There's been many questions to work through here, but I wrote them all down. So if we start off with one-off from new entities, yes, they have been acquiring a lot of portfolios. I think if you could take us to up the appendix, Alexander, I think we have a slide that highlights that. I mean, they definitely have been diversifying their book. Historically, there's been, as you probably realize, probably know, a lot of toxic liabilities, asbestos, workers' compensation, etc. But recently, there has been some diversification in the book. And if we look at the last 6 large deals, we can see that Enstar's actually won 4 of them. So they're definitely purchasing new deals.
Yeah, unfortunately, we don't have them in the appendix, but they have acquired over 50% of sort of the largest deals that have happened in recent years. And then I can tackle a few of the other questions. Let's talk about the bond portfolio and then on IRR. The bond portfolio talking about the mark-to-market losses, and that happened initially when interest rate rose very quickly, when they had an average term year of 4, sort of a bit over 3, just 4.2, 4.3 years. And so they lost sort of a bit on the face value of the bonds. But considering that these are long-term liabilities, they don't have any sort of distress. There's no need for them to sell those assets. So we would assume that those just roll over, and then they reinvest them at maturity into new higher return opportunities, because this will be like 2 to 3% yielding securities. Do you have a follow-up question now, or should I tackle that later, David? I think you might wanted to ask something.
That's good, but that's the argument of the classic insurance company argument. We can hold the bond to maturity. We don't need to mark to market. That's a classic argument they throw out there.
Yeah, sure.
Hey guys, this is Pranay from Fidelity. Sorry, my video, I don't know, it's some stupid IT issue that's kind of, anyway, I'll try to fix it, but thank you guys for the great work. Really good job. I got a simple question. Do you think this is a good business?
I think in general it's not a good business, because like the attractive piece of it is the float. So you can run it well, it can be an attractive business, but it requires an incredible amount of discipline. I would almost call the runoff market as a market for lemons in a way, because you're effectively the patsy at the table. The runoff company has pressure from the insurance company that wants to divest their runoff claim. There's a runoff or a broker who really wants to get that deal done. And so the runoff company knows that his company is decreasing over time. He needs to replenish his portfolio. And so he's very much a deal guy usually. And so that dynamic is not great. So what you really need is someone who has a huge stake in the company. And management owns over 11% here. So that's something we think is very instructive. And taking an insurance analogy, we know how Berkshire runs the insurance division and how they can really expand their insurance activities by 200% in 1 year and not do anything for several years, because it's very much a hit or miss. So we think discipline is very important. And if you manage that right, then the float is valuable and you can make it a pretty decent business. It's there's few ways to compound capital as a good P&C insurance business, and runoff is part of that, but it's tough.
Yeah, I'm not sure Avijit Jain is managing this business, so it might be a little bit different.
Yeah,
but I guess the other question is, you know, the heart of the thesis is sort of like an ROE reversion story. And, you know, if someone were to ask you, all right, do you guys have like a comp for a similar business where, you know, this is sort of played out? What would your response be?
That's a very good question, and it's a difficult one as there are no publicly traded comps. But if we look at Apollo, they bought out a company called Catalina, and they were bought out at a 1.25 times book multiple, which we think is indicative of what this type of business can trade at. But otherwise, it's a very difficult question, but we've really done it the reverse way around. So we're really looking at what's a conservative underlying return on equity this business can return or can generate, and then we just have a cost of equity and then come up with an implied book value. But it's a difficult question assigning like a precise multiple. Like, I think it's a range is probably more reasonable.
And you asked specifically if we can find companies that has had similar thesis arguments with that return on equity normalization. I can't from the top of my head think of any because I haven't explored that much. So unfortunately, we can't provide a good answer to your very good question. I think, David, we never got to your IRR question. We simply here assume we might have been lazy on the terminology. It's like a compounded annual growth rate. So it's the share price today relative to the share price in 2025.
Sense. Yes,
yeah.
I correct.
That's
Yeah, exactly.
Better, okay.
Yes.
CAGR. I'm sure you have a spreadsheet because
I
IRRs are based on cash flows. You don't know what the future cash flows are going to be, except cases like in a bond.
Yeah, so that would have been better to use. But so sorry for the confusion on that.
I apologize for that confusion, but that's exactly how Alexander explained this, but how we calculated that.
It looks like a pretty big number.
Yeah, and exactly. Just I don't want to avoid your questions. Just quickly to add on the losses on the bond portfolios, Mr. Ross. It's the realized losses have actually been there has been a very significant part if we look at the total investment income compared to the realized losses. So we are confident that they won't really balloon out of control.
So I'm assuming that their bond portfolio is diversified across different ratings and time diversification mostly.
Very much so.
Yeah, and the average is a little bit under 4 years. I think on IRR, if we have time for it, I could add that we have a very big, or sort of the compound annual growth rate. We have a pretty high yearly return number out to 2025. We think over time you're getting the return on equity number to 15% plus a few percentage points because of those accretive buybacks, acquired 30% of the shares below price to book, and they're continuously buying back shares. So you could look at a 15 to 20% return over the long term. So our metric.
Unfortunately, I'm going to interject. We're running a bit low on time. Do we have one last quick question before we move on to the next pitch? All right. Thank you so much, Instar team, for presenting. It was a great presentation and best of luck to y'all. But otherwise, yeah, we'll be moving on to the next pitch.
Thank you. Thank you for all being here today to listen to the pitch. I'm Ilene, and today my team and I are from Duke University, and we're pitching Altus. AMS is currently trading at $5.63 a share with a price target of $8.88. To give a brief overview, we see that there's a strong market opportunity with this pitch as the market misunderstands this as a classic energy transition SPAC. It groups it with traditional utility and retail solar companies, which are not comparable to Altus's superior business model, as well as project economics that positions it far above its competitors. We believe that the strategic partnerships that Altus has with CBR and Blackstone, which are the two of the largest commercial real estate companies, creates a unique pipeline and negligible customer acquisition costs, as well as gives access to low cost of capital within these macro conditions. We see that Altus is positioned to be a high growth, well-run business at an attractive valuation.
So how does Altus make money? They pretty much go out to these commercial or industrial companies and they offer to lease or buy the land so that they can build and own and operate the solar panels and sell energy directly from that commercial company's roof to them through a 20 to 25-year contract called a PPA. And just to reiterate that, they're going up to these commercial and industrial companies. They're saying, one, I will increase your revenue by renting or buying your land. Then I'll build these panels myself, commit the upfront cost myself, and give you cheaper energy. The rest of the energy that they're generating from those panels, they sell through net metering. So they have a community solar program where residences such as any of us can sign up through signing an MCA, which makes them entitled to receive solar energy credits or solar credits from on their utility bill. So if your utility bill goes down and Altus ends up taking 80% of that credit, but the resident still gets a lower utility bill without any upfront costs, any installation of any equipment or anything like that. And then any excess energy is sold wholesale back to the grid. The last revenue segment that Altus has is SRECs. Altus pretty much receives these solar renewable energy credits because they're generating this energy. And there's utility companies that need to make a quota for the amount of renewable energy that they're making. So Altus can sell those SRECs to the utility companies. And then finally, this isn't a revenue segment, but there are ITCs, which Altus benefits from. So anytime there's a new project, 30% of that can be funded by an outside tax equity investor through these, and they receive ITCs for investing in that. Turning to management, Altus is still run by its 3 co-founders, 2 of whom come from strong credit backgrounds. And we really want to emphasize that because it's really important for such a project-based business where they're financing these projects so much. So having these strong, skilled capital allocators as the founders and the owners is really important. Finally, it's worth noting that Altus did become public by SPAC. But management and Blackstone, which was invested before Altus became public, rolled over 100% of their equity, and there's been no significant selling since the end of the lockup period. So continuing on the business model, Altus is starting to start acquiring solar panels directly. They recently acquired 220 megawatts from True Green, and we wanted to model out that these project economics were going to be NPV positive, which you can see they are through the model. So moving on to Altus's competitive advantages. First of all, they are vertically integrated, so they own, operate, and provide maintenance to their own solar panel farms. Second of all, there's really low threat of the big utility companies coming into the space because the size of their project is so much smaller. Utility solar companies usually work on projects 10 times the size of Altus's projects. Finally, Altus is the biggest C&I solar company, which gives them an advantage because they have long-term contracts with suppliers, and they already have these 20 to 25-year contracts with their customers. They have very low customer churn. Yeah. So why does this opportunity exist? The solar energy market has seen a lot of headwinds, especially because of the macro and rising interest rate environment. So all these smaller residential companies are pretty much seeing a huge lack of demand because residences don't want to have the high upfront costs of building their solar panels. And second of all, they're having trouble financing these projects because of the rising interest rates. We see this as we see AMPS as largely insulated to this. If anything, it's an advantage to AMPS because AMPS has a long-term fixed rate debt, and they're able to use this to buy the more poorly funded residential companies such as Basalt, True Green, Unico Solar. Additionally, AMPS is not really seeing any deterrence in their pipeline because, as a reminder, they don't require any upfront cost for any of these companies. They're really just offering a lower cost of energy. So looking at the industry overview, as I've kind of already mentioned, you have these huge utility players. They're going and building 100 megawatts in a huge solar farm and then selling it at a smaller margin directly to the grid. And then you have residential solar companies, which are building on people's homes at a much higher rate cost of installation, but then selling directly to that home at a much higher rate. Altus gets to sit in between that, where which allows them to have much better unit economics than either of the other business models. They are building these big solar farms that are much bigger than residential. And then they're selling still at the retail rate to residences and to commercial and industrial companies. So you can see on the bottom right how the installation cost for Altus is closer to utility than to residential, but again, like they're still selling at the higher price.
Yeah, so jumping right into thesis one, misgrouping and poor comp selection, we think that AMPS is incorrectly grouped together with non-residential downstream renewable companies, obscuring its true value as the only publicly traded commercial and industrial solar provider, right? So in the top left, you can see sell side's comps for AMPS. Collectively, they traded down around 27% in 2023. AMPS has largely followed that trend down 21%, right? And we think this is very unfair to AMPS. Why is that the case? That's because AMPS really has this exclusive focus on the C&I solar space, right? That Claire just mentioned, right? You can see this quote from management in the top right. We are the largest C&I solar provider in the highly fragmented market. The comp list that sell side has is kind of, I think unfair, right? You can see that none of those companies have any significant exposure to C&I solar. If at all, it's usually maximum 5 to 10% of their revenue, right? And why is that important? Because C&I solar is the most attractive vertical of solar from, a project economics perspective, from a growth perspective, and from a margins perspective, right? So MS estimates a 20% CAGR in the entire space in general. I think it's also, massively under indexed. Only about 6% of the TAM is captured. That translates to really favorable growth metrics for AMPS. So you can see in the bottom left, AMPS is growing at 54% revenue CAGR since they went public. If you look at the comp list that sell side has, the highest one is 10%, right? So really an unfair comp list, and we think that AMPS is outperforming from a growth perspective. It's really the best capitalized, best run company in the attractive C&I vertical, right? What are some of the other kind of aspects that are contributing to the cloudiness around AMPS? It has to do with kind of SPAC overhang that Claire also alluded to, right? The D-SPAC index is down 70% since 2022. And when you pair that with AMPS positioning as like an ESG solar type of asset, there's a lot of negative investor sentiment. And, I think that really provides an opportunity for investors to extract value at a really good price. So moving on to why we think commercial and industrial solar is kind of the best and most attractive solar vertical, right? The current market consensus view is that utility scale solar, not commercial and industrial, is quote unquote the relatively best house on the block. But when you really dig deep into kind of the installation costs and as well as kind of, what these companies are actually selling their power at, Altus and commercial and industrial solar really revealed itself as a superior business model, right? So when we dig deep, you can see that AMPS can leverage economies of scale. It's installing at $2 a watt versus $3.50 a watt for residential solar, right? So that's about 40% cheaper. But in the bottom left, you can see that they're only selling their power at about 20% cheaper. So that translates to a lot better margins, right? And it kind of makes sense, right? When you think about AMPS is able to build in bulk in one centralized location. If a residential company wants to produce a similar amount of power, they have to build on 150 different houses, right? And that's obviously a lot more logistics costs, labor costs, sales costs, et cetera, right? So kind of that really explains why AMPS is kind of benefiting from these economies of scale, right? And ultimately, what really drives our conviction in this thesis is margins, right? If you look in the bottom right, we have AMPS at a 21% EBIT margin in the light blue. The dark blue comps are the residential companies that are significantly lower, and the green comps, which are kind of viewed as the best house on the block, really good margins, they're also lower than AMPS as well.
Thanks, Holly. So moving into the capital that AMPS uses to effectively finance its current operating megawatts, as well as the growth assets that it's either buying or developing, it's really important to think about kind of what a traditional solar asset financing structure looks like. So usually that asset is going to be funded by a large percentage of debt, as well as that debt's probably going to be raised from a bank, have a 5-year term at probably a floating rate, and it's probably going to be unrated. The difference with AMPS is because of management's credit background, as well as their long-term relationship with Blackstone, they've been able to be rated as investment grade. So their credits are investment grade at A- BBB, as well as the fact that they are able to then sell that debt to insurance investors through Blackstone to the order of $750 million now. And that debt carries a fixed rate at about 4.5% right now and has a term of 25 years. So not only is there a duration advantage in terms of there's no refinancing risk for AMPS relative to peers, which have to refinance extensively, usually on a 5-year basis, which has kind of caused AMPS to be able to roll up these peers who are undercapitalized. There's also they also able to benefit from a lower cost of capital. It's also important to recognize that this capital that Altus has spans the entire production timeline. So from breaking ground on an individual project to putting that project into the securitization facility, and then holding that asset for 25 years and earning the residual cash flows. So for a development asset, AMPS will finance the development with the construction facility. Then they'll pay down the construction facility with the long-term funding facility, which they're able to make incremental draws on, as opposed to a traditional single asset funding facility. Altus has a multi-asset funding facility with Blackstone, which they've drawn $300 million on this year, even in a different interest rate regime. And they're able to kind of generate the residual cash flows from that asset. And then they're able to kind of capitalize on this flywheel, which then allows them to raise more debt, acquire more assets, or produce more, or develop more solar assets. And this is kind of the key growth driver and growth engine of this business. And like the question is, do we have conviction in this growth engine? And if you look at the right side of the slide, they've been able to grow operating megawatts by raising debt remarkably throughout the past few years, especially given the current interest rate environment where other peers are very undercapitalized and have to deal with refinancing their debt, where Altus doesn't. It has this long-term fixed rate debt, which provides them with significant competitive advantage. And something key to this is that they've been able to get rated by the rating agencies, which nobody else has in the commercial space, as well as in the utility or residential space. So this is a key competitive advantage, and we think it's durable for Altus. And then moving on to how this capital plays into the unit economics for development assets as well as acquired assets, you can really think of Altus as a low-cost player. So effectively, for development assets, they're able to finance working capital CapEx at a lower rate than peers because they don't have to deal with this refinancing as well as the floating rate debt that most of the market has. And this is kind of evidenced by them buying various projects that are in development so they can more efficiently finance the development of these assets, as well as on the acquisition side of things, specifically in the commercial market. The majority of players are funds who have kind of a fixed duration of capital, whether that be equity capital from a PE drawdown fund that's experiencing kind of the end of its fund life and they're a forced seller, or from an investor who has raised debt capital from banks and that bank debt is needing to be refinanced in the past couple of years. And this is why Altus has been able to buy about 300 megawatts worth of assets, nearly doubling their total operating megawatts last year, because they have this capital that is deployable in this interest rate regime. It is long-term, and they don't have to deal with the variety of risks that other peers have to deal with. So we think really Altus can not only operate more efficiently than peers, but also it can grow much faster. And we don't even need to bake this into the valuation for us to be comfortable buying AMPS here, which we'll get into later.
Our third and final thesis is that Blackstone and CBRE provides three main competitive advantages. We see that there's low to no customer acquisition costs, as relationships with two of the largest C&I portfolio companies allows for AMPS to attain customers at a really low cost. Second is the real estate expertise. Due to this, AMPS has zero commercial customer defaults in company history. And the third aspect is the favorable contract terms. With price floors to mitigate downside as well as standardized contracts to push deal velocity, we've been able to lock in long-term contracts of 20 to 25 years plus with stackable revenue opportunities. You can see this to the right of the slide where the land and expand strategy that AMPS takes in, where they partner with these companies and able to use them into a referral network where they're able to implement their strategy to add on EV charging stations as well as battery storage, allows them to really stack their revenue opportunities as well as growth. In the bottom, we see that in the no growth harvest case that we modeled out using the existing contracts that AMPS currently has, Altus is about at its current valuation without factoring in any contracts. Buying at today's price means that any and all future growth that Sam mentioned and the sustainable growth that the pipeline business has is being essentially bought for free.
Yeah, so quickly moving into the model, we wanted to focus on growth levers, that being primarily the pipeline from a development and acquisition standpoint, as well as where did the revenue come from, breaking that down into a price per megawatt hour for each of the segments. Sell side really just slaps on a general price per megawatt hour for all the megawatt hours generated by this business, as well as a growth rate on the cumulative operating assets. But we really wanted to segment out and understand how the capital flywheel works, as well as take a view on each of the revenue segments and the energy prices there. And we were overly conservative in this case, using effectively historical prices for the revenue side of things, with a little bit of SG&A leverage on the income statement side of things. And with respect to growth, we've modeled in one large scale acquisition using the kind of true green acquisition capital structure as a blueprint. And then we've kind of modeled in a little bit more than last year in terms of construction development for the next projection period, which we think is kind of overly conservative, but also captures a lot of the growth that we think is very sustainable from Altus, given the supply and the ability for Altus to supply the market, given its capital, and the demand, given the pipeline that Altus has. So then moving into the valuation, we think it's really important to value this company on a long-term basis and take a long-term view. In order to do so, like Ilene mentioned, we used a harvest DCF, which effectively projects out the future cash flows of the current operating assets. So that's assuming no additional debt draws, no growth, no development, no acquisitions, just the current assets and throughout the weighted average life of the PPAs remaining, which is 18 years. And then what does that look like for the equity? And that effectively, also the margin profiles using current unit economics, that effectively takes us to the current share price, which makes us feel really good about buying Altus here and the strong margin of safety relative to the base case returns with modest growth assumptions and none of the verticals that Ilene mentioned in terms of EVs, batteries, storage, etc. So we feel we can buy Altus here and get all the future growth for free. And we have high conviction in the growth case or the base case effectively, where Altus grows, continues to use that capital and continues to capitalize on the flywheel and unique competitive advantages they have to scale into one of the prominent C&I players in the US.
Yeah, so just really briefly touching on comps, you can see on a margins basis and a growth basis, AMPS is really far outperforming both residential and utility comps. And yet it's trading kind of at a discount to those comps, right? So again, this really adds conviction to the idea that, AMPS is a superior business and really is a really good opportunity to, purchase this high quality business.
Lastly, to finally highlight some macro conditions briefly, we see that a lot of the headwinds that Claire mentioned for the macroeconomics or the macro conditions for solar companies have actually been tailwinds for AMPS. Specifically highlighting the extent that this is an US election year, the ITC is locked in for at least 10 more years, and whether it be a Republican or a Democratic sweep, the solar industry will continue to remain strong. And with that, thank you for your time today.
All right, thank you so much. Judges, if you have any questions, let's get started.
Yeah, I can start, guys. Really, really good job. My background is I actually run an infrastructure fund, so this is super interesting to me and something an idea actually I'd heard about. I guess the first thing is I love the idea of this sort of steady state cash flow yield that you guys did, which is sort of what is the runoff value of assets to frame, the downside case. So really good job there. With getting these stocks right, it often comes down to financing, which I think you guys covered, but obviously growth CapEx. And if I looked at your model, I think it was a couple slides ago, it's like your growth CapEx numbers over a 5-year period are roughly flat. Like it's 103 million in 24 and then 107 million in 29. So, and then you've got revenue growing a lot. So implicit would be that sort of like the CapEx intensity of the business is improving. So I just kind of love you to explore that. Like how is CapEx flat and growth sort of pretty strong?
Yeah, so I can touch on that. So the way we looked at growth was we basically kind of considered a lot of the growth to be from development assets. So those assets where Altus is going to a company that's an organic kind of generation, organic revenue generation, as opposed to buying a dislocated player. So the reason that CapEx is steady is we effectively assigned we basically modeled the pipeline. So we have a fixed number. Altus reports the amount of total megawatts in pipeline and where they are in the stage of that pipeline. So how much of the construction is in actual construction, or how much of the development pipeline is in construction, how much is in contract, how much is in initial planning phase. And we used the company projections of what's in closing and the percentage of that gets done every quarter. So last quarter they did about 25 megawatts of completion for 75 megawatts this year. And we basically, the growth CapEx just flows from that line item, from mainly from the construction, whereas the acquisition CapEx is in a different line item that we didn't show on this kind of summary slide. So the acquisition CapEx, like you see in 2024, we acquire a 100 megawatt asset, just given kind of the interest rate volatility these days and where Altus sits in terms of their capital and the competitive advantage that's along with that. But really the growth CapEx is stemming from what we have in the pipeline construction completed, and in terms of like how much we're paying per megawatt for that.
Okay, and just one more for me. So I guess your point is there's no competitors in C&I, but why is this a better business than utility scale solar? Apart from the lack of competition, sort of a unit level, what is attractive? Because obviously you have tons of utility scale companies you can sort of invest in. But what would be the one competitive advantage of this business over utility scale?
Yeah, I think I could touch on this briefly, and then some of my teammates can add on this. But I think a lot of it just has to do with kind of the price that they sell at. So you can see in the bottom right, the utility scale is selling at like the wholesale price. which, it varies from, geography, but it's only about $1, right? So, obviously, like, Altus, the installation cost is significantly higher than the utility, but it's almost like they get to develop at a cost that's more similar to utility and then sell at a cost that's more similar to residential, right? So that's why we kind of see, like, from the margin perspective, from the project economic perspective, we do view it as superior to utility.
This is Dave. I've got a few questions. When I was introduced, I think you said Angelo. It's Angelino Group, which is a climate change fund that I'm the senior advisor to. And we've got a lot of solar investments and supporting organizations. You may want to go look at the website, a lot of information there. But my questions are related to, you show Sunrun, which in my view is a shadow grid on rooftops. Okay, they're using people's homes to create a grid. And what AMPS seems to be doing is focusing on community solar and the growth there rather than individuals, which I think is good. We just built a new home in New Hampshire, and we went through several solar companies and realized it just doesn't pencil out. So now I'm working on community solar up here. So I think it's a very good business. One of my concerns, though, is they're in the danger of becoming a real estate company if they're buying real estate rather than leasing it. So I was wondering if you would address that. If that's a component of their returns, it could be a negative driver, actually. And then I had a couple of questions on their geography. Where are they currently building this community solar? And are they using fixed or trackers? And where do they source the panels? I'm sorry, a lot of questions all jumbled there.
I guess I could start with panel sourcing. I think like they're moving. There's also been like a lot of kind of positive macro tailwinds with regards to this. The new IRA really incentivizes panel sourcing from the United States. And I think I think Ilene can touch on this as well. They've had like, long-term suppliers that they have, pretty good relationships as well. So I know that, there's a lot of tariffs with regards to China, but I don't think we see that as a risk.
What about the geography question?
Yeah, so we didn't include, I don't think it's in the appendix, but with respect to community solar, Altus is like very well geographically diversified across the entire country. There's not a ton of concentration in a single state or single region of the nation. So the geographic diversity is, and the diversification that comes alongside that is relatively strong. So it's not, I don't think it's in all 50 states, but it's in like a large majority of the states across different regulatory disciplines, as well as different political situations. And then your last.
Sorry. Specifically, they have projects in 8 different operating states, and recently they've expanded within California with a major acquisition of Unicore Solar. But Sam can go on about the rest of the question.
Yeah, and then I guess we didn't touch on the purchasing the real estate. So right now the majority of the real estate is leased. But Altus, when they're purchasing the land, they're not doing that in the vast majority of their projects. It's a small percentage of the products that they actually purchase the land for, but usually those products are more conducive to kind of the verticals and upselling with respect to EV charging, as well as putting storage in where the unit economics make sense for that. So that's where they're kind of allocating capital to actually buying the real estate, as opposed to just opportunistically purchasing roofs or land all over the country.
Eugen, do we have time for a few more?
Yeah, we have time for 1 or 2 more questions.
1 or 2 more. Okay. Awesome job. I agree with the framing of the downside case or getting the growth for free is really sophisticated. So that was awesome. Can you guys, I guess just one, did you mention that this company came public through a SPAC?
Yeah, they SPAC'd in 2021, late 2021.
Can you guys talk about that decision if you spend time on that deal and why you think this company would have chosen, why did it make sense for them to be a public company? Why did they choose to go the SPAC route and how that might be affecting the share value today?
100%. So it's actually quite an interesting scenario. So management is actually really sophisticated And the reason they SPAC'd, they put about 300 million of cash to the balance sheet from that SPAC. And a key point of that SPAC was combining with CBRE Holdings. So it was a CBRE run SPAC. So that was like obviously provided a lot of natural synergies for pipeline, as well as, so yeah, it was with CBRE as well as like an efficient way to put cash to the balance sheet in a good market for those types of deals. But also CBRE is a big partner in terms of the development assets. So CBRE helps AMPS a lot with planning of new solar facilities, in addition to like increasing the pipeline. So it was like obvious synergies for CBRE as like a preeminent real estate manager, as well as AMPS as kind of digging into that commercial and industrial TAM, as well as using CBRE network to really increase the development assets side of things. So like they released a strategic plan with CBRE to increase the amount of assets they are building. And in 2022, they built 11 megawatts. In 2023, they built 75 megawatts. And that's primarily through leveraging that relationship with CBRE. So there was pretty obvious synergies. And management thought going public was a reasonable way to raise capital at the time. And they're kind of very intentional with their capital allocation decisions. And they've talked about, interestingly, the company does not have a lot of coverage. Like a lot of the investor days have 100 views on YouTube. Video yesterday had 15 views. And management really is saying that the market does not understand the business, or really they need to put the word out there about how Altus has a different to the utility and residential solar models, because it doesn't really have any comps. And that's kind of been weighing on the share price. So management's kind of aware of where they stand in terms of their owner base, because they still own a lot of the float and a lot is public. Sorry for the long-winded answer. Yeah, that's kind of the rationale behind the SPAC.
It sounds like one of the few SPACs that actually makes a lot of sense. Last question for me is, like, I recall being in DIPP like a decade ago, and we were looking at solar ideas like back in 2013, and the market just feels like it's been really choppy. So can you guys, like, I'm sure you took a long look at solar over the past 2 decades and what you think that market's going to be for the next 2, but like, why is right now, January 2024, the right time to put money behind a solar business?
I can touch a little bit about the macro and the regulatory headwinds and the tailwinds that we actually see that for AMPS. We see that solar currently, there's a lot of negative investor sentiment about the hardware cost inflation, as well as rising utility rates, as well as general ideas about Chinese imports, as well as tariffs on that. However, right now we see that AMPS is able to capitalize on these tailwinds actually in the solar market in general. And we see that this is going to continually become a positive growth market in the future, even with regardless of the Republican or Democratic sweep. So we see that both political and regulatory policies are supporting the solar market in a substantial manner, with tax credits as well as investments by the government. But also in the same way, solar is becoming increasingly cheaper as we continue to develop technology, and AMPS is able to capitalize and really grow their margins with this. So I think that's one of the key reasons.
Sorry, and just to like add finally, I think it's a really good time. There's obviously a lot of volatility in the market with rates, with energy prices, with the election coming up, et cetera. It's a really good time to capitalize on that dislocation, which I think AMPS has kind of a high beta to that dislocation. So like the dislocation for AMPS now is something that we feel is strong, and we feel that macro conditions are strengthening AMPS as a business, especially given kind of the capital and the way management runs the business. So I think it's a really good time to invest in AMPS, and we're bullish energy long term. We think AMPS is kind of the best way into this niche kind of solar market, which is the commercial industrial space.
Yeah, just to really just drive this point home, like AMPS is down like 20-30% on the year, and yet like it's continuing to grow, it's continuing to improve margins, it's continuing to produce cash flow, right? So we think that there's really a mismatch with regards to the company's performance and the equity performance. So obviously that's a really good opportunity to invest.
Makes sense. Thank you guys. Awesome job.
All right. Thank you so much. I think unfortunately we're out of time, but thank you for your presentation.
Thank you.
Thanks, guys. Really appreciate it.
Yeah.
Awesome. Thank you so much for progressing us through to the final round. We're really excited to be here. We're from the London School of Economics, and today we'll be pitching a long recommendation for SSR mining.
We'll start by providing an overview of the investment story. We believe that SSR, a company with strong fundamentals, has been undermined by the market. Share prices have sunk to a 5-year low of $9.64 following the November 2023 earnings call, when management announced a production downgrade. Price to book value has been steadily decreasing and is now less than 1. Revenue and total reserves and resources have been increasing, This information represents a small part of a much larger mispricing story.
So there are three core reasons as to why we believe that SSR is undervalued. Firstly, the market is myopic and has become impatient following the Q3 downgrade. Secondly, non-core metals and ore quality is not being appreciated and fairly valued by analysts. And thirdly, M&A has been consistently more accretive than analysts and even internal expectations are predicted, which again is not properly appreciated by the street. Ultimately, we make a long recommendation over a 4-year time horizon at an implied price target of $14.52, representing a 51% upside.
Now for an overview of the company. SSR is a gold, silver, copper, zinc, and lead producer with 4 core operational assets across Argentina, Turkey, Canada, and the US. Some highlights include Kopla, which is one of the largest gold mines in Turkey, Marigold, which has had record production levels in the third quarter of 2023, and Puna, a silver zinc mine which has had incredibly strong 2022 exploration results. Regions in development also hold exciting potential for SSR. For example, Çakmaktepe is an extension of Kopla and has reported promising exploration opportunities. Additionally, Hod Maden is a fantastic, high-quality copper-gold mine which was purchased in May of 2023. The company also boasts a robust exploration pipeline.
SSR merged with Alistair Gold in 2020 and acquired a stake in Tiger in 2021 before their acquisition of Hod Maden in 2023. The company has undergone the sale of non-core mines with the intent to streamline its portfolio and use funds to invest in core assets. The most recent sell-off was of San Luis last month. A consistent track record of accretive M&A is suggestive of a strong and experienced management team. Next, we will zoom out to consider the mining industry as a whole. Gold demand, driven mainly by jewelry and tech, stays consistently stable. Investment and central bank demand is much more variable, spiking significantly in 2020 due to COVID-related uncertainty as investors flocked to gold as a safe haven. Demand will largely be driven by major elections in 2024 as investors hedge using gold. Meaningful resources are becoming more scarce now than ever, despite exploration budgets rising, which hints at how well-positioned SSR is. In fact, gold exploration has a less than 0.1% chance of turning a site into a productive mine. Ultimately, mining is a tough industry to remain competitive in.
SSR outperforms competitors with higher ore quality and low all-in sustaining costs, or AISC for short. As Fareed, the CDO, says, their portfolio of growth projects features some of the highest returning, lowest capital intensity projects in the whole sector. However, the company is trading at the bottom of the barrel. SSR has lower than average AISCs than comparable midcaps and is making meaningful strides to mitigate ESG risks. They also have a particularly strong net cash balance compared to other comps. We see a wide moat for the company, composed of a high-quality, diversified portfolio of assets and excellence in processing methods. Geographical value levers also exist through their existing foothold in Turkey, especially considering their exploration pipeline. Experts recognize the quality of their processing methods too. They have done an absolutely superb job within their pressure oxidation operations, for example. Despite this, though, the company trades at a much larger discount to net asset value than similar peers. We believe that SSR deserves a re-rate to trade at the very least in line with industry averages. We have a deeper dive into each competitor in our appendix.
Let's move on to talk about the first building block of our theses. The market has been incredibly cynical after the 10 to 15% production downgrade announced in the third quarter of 2023. Since then, the share price has suffered a 29% drop, whilst the broader industry has remained consistent. Thus, analysts are in agreement that this call was the largest contributor to the shortfall.
Essentially, the company is moving into a 3-year reinvestment cycle, and we believe that the street is being far too myopic. Delving deeper into the transcripts reveal that the reinvestment is needed to begin work on Hod Maden. Importantly, a large part of this was actually driven by success in expanding the scale of the Çakmaktepe extension. Another grinding and leaching circuit is also needed at Kopla to improve metallurgical recoveries. So investors need to be patient to unlock project upside. The new circuit will deliver a valuation uplift for the entire operation in Kopla, and as we'll discuss soon, Hod Maden is a world-class asset, which we expect to be very successful. We took a look at broker reports as well to gauge consensus views. Bank of America and RBC agree that there is significant long-term value in the portfolio. However, they are both more cautious about materialization risk. Here's where our pitch really starts to diverge from the street. In the appendix, we show that SSR has achieved or beaten production guidance in 11 of the last 12 years. We see this trend continuing and have confidence in management to execute their exploration plans on budget. We see the present as an opportunity to buy at a heavily discounted price following the surprise from the earnings call. Here, we try to appreciate the concept of time arbitrage in finding value. Now we'll justify our confidence in SSR's ability to compound asset value over the cycle by studying Hodmaden, recalling that this was part of management's justification for the reinvestment cycle. Hodmaden was acquired in May of 2023 for a consideration of $270 million. In a very short period of time, we have seen NAV compound by 1.5 times, excluding exploration opportunities. We see multiple growth levers to be pulled within exploration too. For example, the potential for synergies in Turkey with copper and the holding of key permits enables them to do much more with this site. Hodmaden is one of the lowest capital intensity mining projects in the world. The curve in the bottom left corner splits ASICs in the gold industry by quartile, and Hodmaden has lower costs than almost all global competitors. The value of this cannot be understated, and markets agreed. The share price appreciated by over 21% following acquisition. However, this upside has been completely eroded by current myopia. Canaccord underestimated IRR, and UBS didn't change their valuation, despite citing their excitement on the project multiple times. We reiterate that the Street is focusing on near-term downgrades over long-term potential, which we can take advantage of as investors.
Next, we discuss the first part of our second thesis, the market's underappreciation of non-core metals such as copper and silver in core jurisdictions. While the vast majority of SSR's revenue comes from gold, management has plans to invest significantly in copper exploration. New high-grade copper discoveries are rare and in high demand as copper is vital to the green energy transition. SSR holds a 70% stake in Copper Hill, which is situated on one of the last underexplored belts for major copper discoveries in the world. The site has abnormally high marginality and mineralization starts close to the surface, so we expect this to be an open pit project, the cheapest type.
Looking at silver production was also really interesting. We feel we have another differentiated view from the Street, as we found that analysts at UBS don't forecast any revenue at all from silver post-2027. We think because of the sell-off of 2 silver mines in non-core jurisdictions. However, high-grade silver has been discovered at Puna, and management sees this as a very compelling future target. Further, Kopler's technical reports estimate more production of silver than gold until 2042. So all in all, we believe that the Street is underappreciating the revenue that non-core metals can add in core jurisdictions.
For the second part of our thesis on underappreciation, we look closer to a key driver of our model, ore quality. In short, higher grade ores yield higher margins. Extraction becomes less energy intensive as grades increase, and metallurgical recovery rates, which is the percentage of valuable metal extracted from an ore during processing, increases as grades increase.
SSR's mines boast average grades 1.5 times higher than its competitors. However, in the third quarter earnings call, grades at CB were downgraded by 20 kilo ounces per annum. As a result of this, we believe there has been a great deal of negativity bias which is shrouding the success and quality of its other mines. For example, extremely high-grade silver has been discovered in Puna, meanwhile Copper Hill and Hodmaden boast copper grades over 3 times higher than average. Hodmaden's superiority is further evident in the graph in the bottom right corner, which illustrates global gold-copper assets by grade. We firmly believe that the caliber of these mines merits a premium valuation and reiterate that this company should not be trading at the bottom of the barrel.
Now we come to our final thesis, that mine acquisitions are always more accretive than the Street or even internal estimates have expected, and the market is underestimating SSR's ability to compound NAV. As discussed earlier, the net asset value of Hodmaden has been compounded by 1.5 times since the announcement just a few months ago. Given a longer time horizon of a decade, we saw NAV grow by 5.6 times at Marigold and by 2.8 times within 8 years at CB. Crucially, this excludes exploration capabilities. So even in this case, we see some conservatism in estimates.
In the longer term, we see upside to be realized from such exploration capabilities across multiple assets. SSR aims to increase Kakmak-Tepe ore production, with ongoing exploration expected to boost annual growth by 5 to 10% post-2027. Marigold aims to raise production by 2026, while Hodmaden is projected to contribute starting in 2027 at low costs. The sell-off of 2 silver mines, Pitarrilla and San Luis, was underestimated by analysts. Announced sell value was around 2.4 times higher than analyst NAVs, which underpins our thesis on the underappreciation of non-core metals. Ultimately, the sales are being ploughed into growth in core jurisdictions. SSR's dividend yield is among the highest of its competitors, and nearly 18 million shares have been repurchased since 2021. The company has a strong financial standing with a high cash, low debt position, giving them more firepower than competitors and the agility to snap up expansion opportunities.
And now we move on to valuation. So we use the DCF model to determine the intrinsic value of each asset before assigning a probability weight to each of 4 scenarios to obtain a final price target of $14.52, representing a 51% upside. At 0.68x, our base case price to NAV is consistent with current implied multiples, and our drivers included a commodity price forecast, which are detailed in the appendix, metal grades, total ore milled, and average unit costs. We also used a WACC of 8%. Our blue sky case used NAV straight from management estimates, and across the bull, bear, and base cases, we vary the drivers mentioned. It is notable that we skewed probability down towards the base and bear cases, which we feel feeds into a more conservative valuation. And now we'll use a football field to further contextualize our price target. To do this, we looked at the EV to EBITDA and EV to revenue of trading comps, a discounted cash flow model, analyst price targets, and a 52-week trading range.
And now to take stock of our pitch view versus consensus. Our first thesis considered market myopia on the long-term strategy shift of the investment cycle, announced in the third quarter call. We modeled Koppler using management guidance, ensuring a moderate valuation uplift at the end of the investment cycle.
Our second thesis looked at the underappreciation of non-core metals and ore quality. The pitch assumes continued silver production in line with guidance, and in the bull and blue sky cases, we model with the higher end of management guidance. Unfortunately, Copper Hill and Hod Maiden cannot be modeled granularly as their technical reports are yet to be released. We used ore grades as a driver for each mine, keeping in mind the link between grades and metallurgical recovery. And finally, our third thesis was included in the blue sky case.
The biggest risk for mining companies is related to ESG. In June 2022, a cyanide leak caused a 3-month suspension in operations at Koppler, and share prices fell after the announcement. Investors feared the company would lose ownership of Koppler. However, SSR was very quick to publish a document to dispel misinformation. All cyanide was neutralized by mud in the spillage area, and there was no negative impact on the environment. Further, SSR has now become a signatory of the Cyanide Code, a voluntary program where third-party auditors check compliance to high ESG standards. Another risk is that exploration success is rare and slow. However, the Kakmaktepe extension project delivered first production just 6 years after initial discovery, 2.6 times lower than the industry average of 15.7 years. Given SSR is gold-focused, the concern relating to thrifting has a lower chance of materializing. And finally, foreign exchange risk from exposure to Argentina and Turkey is important to note, but we feel that the company manages it well by hedging against fluctuations.
Another equally important part of investing is outlining catalysts to be realized. In the near term, the release of production guidance and fourth quarter earnings in February will allow us to update our models. In the first quarter of this year, the updated multi-year guidance will be a great indicator of performance within the cycle and ramp-up timelines. And crucially, Hod Maiden's technical report will allow more granular modeling of the project.
And for the medium to long-term long-term catalysts, we see the end of the investment cycle in 2027 as a major turning point. So we expect it to be met with a significant uplift in valuation according to management. And finally, exploration is always ongoing and is poised to deliver upside. We expect any major discovery to be met with confidence after the 3-year cycle ends. The company also has a great track record of accretive and disciplined M&A. So we expect such activity in the future and believe that each deal would demand a premium based on its scale and quality. Thank you so much for organizing, listening, and judging. Here's a list of the slides that we have in our appendix, and we would now love to hear your questions.
All right. Thank you, SSR team. It's great to see you in the finals. Judges, if you have any questions, feel free to get started.
I'll start. So just flawless. I mean, you guys just don't skip a beat, and I felt the logic was so easy to follow even for a business that's extremely unfamiliar. So fantastic job. Can you talk about, it sounds like there's 6 or 8 key commodities or precious metals that SSR is mining. What are the sorts of products that create demand for those metals? You talk about gold and demand for gold as a hedge to geopolitical and macroeconomic activity, but what about the rest?
Definitely. It's something that we've really considered a lot, especially because of the fact that it makes up one of our theses. So I can start off and my teammates can continue. Specifically, we looked most at silver and copper, so we'll dive more into them. For silver, one of the main drivers, and for copper as well, is the trend towards ESG and the green revolution. So both of them are pretty important to creating the technology needed for like different types of green technology. So for example, I'm pretty sure copper is used in solar panels and silver also. Within silver, we've seen a lot of what we call thrifting in the silver industry. So companies are trying to cut costs, and so they're reducing the amount of silver that they're using. However, demand for silver in jewelry is still remain pretty constant over the long term. But we've seen ESG demand contract slightly. Silver is also used quite heavily in medicine, so it has, I'm pretty sure it has some antibacterial properties. And so a lot of cutting edge medicine is using silver nanotransmitters in the medical field. As for copper, it's an extremely important metal, and it's always been at the forefront, especially of M&A. So we've seen that push in demand also translate over to more demand for M&A. So I think the metal in highest demand for the previous year's M&A was copper and actually not gold. So it's a very like hot metal at the moment. Again, it's also vital to the technology and green energy transition, uses a major component in smartphones, etc., and also used in the medical field as well. So we do see very strong demand for it. Copper demand has increased a lot by all of the factors mentioned. I don't know if my teammates want to add to it.
I'd be happy to add a bit. So in terms of SSR specifically, the gold actually becomes doré bars, of which central banks are quite a significant client for this company. And in terms of silver, also it's sold on the London spot markets and the Istanbul Gold Exchange, whilst the metals produced in Pune, which are silver, zinc, and lead, are sold in concentrate form to smelters and traders.
I got a question on the environmental impact of the mines. You did mention ESG and the cyanide. I'm assuming they're using open pits where they put the cyanide to separate the gold out. I was actually at the University of Texas from 1997 to 2001, and I created exposure to the Goldman Sachs Commodity Index, which was 27 subcontracts of commodities, including precious metals and energy, mostly energy, 68%. But we tracked all these different metals, and I would not say that gold is a hedge for an institutional investor. However, after I left, the University of Texas bought $1 billion in gold bars. I don't know what happened to that. But it's fear and greed. That's what drives gold prices. And so I'm just curious, in your modeling, did you think about, well, what if gold drops to, $900 an ounce, in troy ounces, by the way, not where it is now, about what, 2060? I saw that somewhere. Oh, there it is, right there. Yeah, there we go. So how does that affect your valuation?
Yeah, this is something that we thought about long and hard, especially because the formula that we use to calculate revenue directly depends on this. We tried to vary it across 3 cases: bull, bear, and base. Sorry, this one should say base and that one should say bear. But yeah, the bear case is obviously the one with the most downside. We did a lot of research into it, and we found it difficult to accurately predict commodity prices post 2027, 2028, just because they vary so much and depend a lot on uncertainty and recessions. But yeah, I think Neha can talk more about this.
Yeah, so I do feel like we were fairly conservative with our gold price estimates. For 2024, we dropped it from current high prices, mainly to remain in line with the continued Middle East tensions, lingering US recession fears, and the potential for central banks to remain big buyers of gold. They were the major driver of gold prices in 2023. And then we consistently dropped off until 2027, where we then kept straight-lined our gold prices. To take in mind your point of what would happen if gold prices dropped to low levels, we did we did input that into our model. We inputted a $1,200 dollar price for like by 2034. We dropped it off and it gave us a -2% downside. The $1,200 came from a average of the gold prices between 2014 and 2019, so pre-COVID. And yeah, we got a -2% downside with that price.
We do see that very much as a doomsday case, though, and we've read recent reports from JP Morgan and some other banks as well, saying that next year and the next couple of years especially will be great years for gold. But we also very much keep in mind that
I'm sorry, I was at Credit Suisse, and the global investment team always had 5% gold in the portfolio. There was really no reason for it. I had to laugh. I'm sorry.
Maybe one for me. Really good job. Incredible amount of detail and really nice kind of like scenario analysis. Super high level question is, you guys kind of studied the mining industry. Would you say that mining is a good business?
I think that it's something that will always be somewhat necessary. I feel like when we looked at demand for gold and then more like precious metals in general, it always seems to be rising, and also in terms of the tailwinds from emerging markets too. In terms of if it's a good business, we think that when looking at it from an ESG stance, a lot of them are making more strides becoming more environmentally friendly. So especially this company, they're trying to use a lot more water recycling, and then they've advanced a lot of net zero targets and have a lot of community relationships to try and make them stronger on that front. But where we really see this company as super interesting is efficiency. So I think as mining companies can try and become more efficient, they become really interesting to investors, especially when they can create value from certain M&A.
Great.
I think we have time for one or two more questions if any of the judges have one.
Yeah, maybe I'll sneak another one. I think that, you know, if I was thinking about the bull case here, it sounds like it's a complicated business, but your thesis is, look, the assets are super undervalued, right? And it takes a bit of work to kind of get there, but you know, sort of even, I think even your bull case is kind of like a discount in NAV. And so why wouldn't sort of a large miner want to buy this business, right? Have management indicated that they're willing to sell the business? And just any thoughts there?
I think we read a lot of transcripts and we read a lot of thoughts from management. We didn't see anything on management wanting to sell. They recently bought up Alaska Gold, and I think from the sounds of the earnings call, they all seem really excited to start work on Koppler and start work on Hod Maiden, because this is a huge asset and is kind of the crown jewel of what they've created for so many years. Also, they're moving towards this reinvestment cycle, so I'm not sure how that's going to pan out, and I think that management seem to want to stay with it until then. But yeah, I'm not too sure. We haven't seen too much on that.
Okay. Are there any other questions? All right. If not, thank you so much, SSR team, for the presentation today.
Thank you.
If you could stay on, so we can you know, move you to attendee, and if the CROX team can raise their hands, that would be helpful.
Thank you so much. Great job.
I'm joined by Tyson Boynton from Middlebury as well as Ludovico Monti from Boston College. And are we good to go to start the pitch?
Yeah, go for it.
Okay, amazing. Thank you all for being here today. Today we're pitching CROX, which currently trades at a share price of $101. We have a 2-year price target of $249, representing an IRR of 57%. CROX distributes its products through 2 channels, wholesale and DTC. With wholesale, CROX gets less control over pricing and marketing, but it really leans on wholesale distributors to grow, especially internationally. The opposite is true for DTC, with which it really has full control over pricing and marketing, and physical sales have been declining as a percentage of units sold over time, whereas e-commerce has been rising. In fact, e-commerce has really been soaring since 2015. In 2015, 11% of all sales were through e-commerce, whereas today it sits around more like 38%. The bottom chart shows the shifting revenue mix over time, with 40% of sales through DTC around 15 years ago, whereas today it sits around more like 45 to 50%. Conceptually, in terms of the competitive landscape, CROX sits somewhere in the middle of the spectrum between fashion and functionality, competing with the likes of UGG, Birkenstock, and Merrell, although it does take a page out of the marketing book of companies like Yeezy, these higher-end brands, as CROX tries to establish itself as a more fashion-forward brand. However, it doesn't compete with these higher-end brands, given the differences in price point, as well as CROX' emphasis on comfort.
Before we can spend time looking at valuing CROX's future prospects, it's sort of important to spend some time also looking at how the business was valued in the past and show that the market, both on the upside and the downside, in our views, offered highly rational prices on CROX shares, but based on what was reasonably expected during the period. Business very early on went through two boom and bust cycles. One was driven by over-distribution in the wholesale channel, where pairs would end up at your local gas station heavily discounted. And the other one was driven by an ill-fated expansion of the company's own retail network. Both resulted in over-inventorying and severe discounting, consequently hurting margins and, most importantly, brand equity. The big picture here is CROX was a static business for a nearly entire decade with flat sales and anemic margins. Until 2014, however, when Blackstone invested in the business, overhauling management and putting Andrew Rees in as president, who would later become CEO in 2017. The change in strategy with the new CEO effectively hinged on two pillars. One was solving the relevance problem. Brand awareness for CROX was high, but no one wanted to wear them in public. So CROX hired a new CMO, and with a new marketing strategy fueled by collabs and endorsements. Second was solving the distribution problem, effectively consolidating retail touchpoints and retaining higher control on their wholesale ASPs. As a result of these changes, operating margins began to tick up from anemic to over 12% in calendar 19. Overall, we view this as sort of the core tenets of the brand have shifted from growth as a product of faddism to controlled distribution and strong marketing execution. More recently, COVID took the business to new highs with sales doubling and also margins doubling to effectively around 30% in just 2 years. And aside from the work from home benefit, CROX became a teen fashion staple and seen success with its new collab-driven marketing strategy. More recently, in 2022, shares collapsed over fears over sales and margin sustainability, as well as fears over a potential mounting recession. However, the brand continued to put up growth, effectively comping the comp in 2021 and growing in all three geographies. Furthermore, footwear retailers, checks that originally skewed negative now have become overwhelmingly positive on the brand trajectory, citing that the brand had effectively broadened its customer base in a significant way. On a go-forward basis, the bear case expectation is no longer for a collapse in sales, but for stability and growth in the current phase. So contrary to investor fears, we believe CROX brand equity is actually stronger than ever and have done significant web scraping and channel checks to verify this. We've scraped pricing and SKU information, search and media data, as well as wholesale reviews across all DTC channels and major wholesalers across all major geographies, finding evidence of significantly less discounting to clear inventory and accelerating brand interest across all mediums. For HeyDude, we found similarly strong results for the brand with a pronounced emerging presence in historically less popular states across the entire country. Lastly, we found there to be high levels of interest in new SKUs for both brands, which on average are selling out in the first week and boasting high resale values on secondary markets. Admittedly, the optics of CROX at first glance make it appear like maybe one of the most obvious short candidates out of the back of COVID. It's a seemingly fatty brand that's also suspiciously correlated with the COVID boom after a decade of stagnation, a clear COVID beneficiary being ugly but comfortable, and coupled with ludicrous and seemingly unsustainable operating margin expansion from anemic to over 30%, all from the same old foam clog. As a result, sentiment is skewed negative following CROX's COVID Palapalooza and an untimely acquisition of HeyDude. While EPS estimates have been revised up significantly over the last 18 months, the stock has lagged behind and is effectively flat. CROX's multiples compressed significantly versus peers while historically trading relatively in line, despite having a superior growth story. And furthermore, our own analysis of comparable footwear brands and their implied multiples implies that the market's ascribing almost no value to HeyDude, which is a $1 billion run rate business with 30% EBIT margins. Overall, investors have clearly struggled to become constructive on CROX's increasingly complex story, which we believe creates room for a variant view.
our investment thesis is focused on 3 key points. One is we believe the sell side is mismodeling HeyDude's inventory issues. 2, we think there are growth initiatives that provide unmodeled option-like upside. And finally, we think margins and volumes have reset to structurally higher levels post-COVID. We have a 1-year price target of about $200 with a 4.1x reward to risk ratio. We also like the near-term setup, with CROX trading at just 8 times forward EBIT as opposed to 15 times historically. On top of that, we have 10% of the float that is sold short, and we like the opportunity for the management team to buy back about 15% of the market cap in the next 12 months. We have a base case price target of about $250, an upside case price target of about $340, and a downside case price target of about $75. So we think HeyDude has really been the key driver of the stock in the past 12 months. As you can see in the chart, in Q1, the management team guided for mid-20s growth for HeyDude. The stock was up. In Q2, they lowered it to the mid-teens. The stock was down. And eventually in Q3, they lowered it again to 5%, and the stock was down again. Obviously, that's only one part of the consensus view. The street is also worried about the headline comps for HeyDude, which look tough. HeyDude is a brand that basically doubled in 2022. And obviously now those numbers are reflected in the 2023 numbers. Our view is different. We think that the actual number of customer dollars that have been spent on HeyDude in the past 3 to 4 quarters has been growing. We estimate that it has been growing at about 30% year to date, as opposed to kind of like the flat growth rate, the surface level numbers for sell-in. And so we believe the demand for the brand is still healthy and growing. On top of that, we think the Amazon discounting issue is to be resolved in the first half of 2024. And we also think inventory issues are priced in and reflected in the estimates. On top of that, we have done a number of channel checks to confirm HeyDude's inflection in 2024. We have called a number of stores from different chains throughout the country. And while a very small number of stores pointed out to high levels of inventory for HeyDude, all the stores that we called pointed out to the continued brand heat and demand from customers for HeyDude, which increases our conviction in the 2024 inflection. On top of that, they are gaining mind share among the faster growing younger cohorts. We have a number of transcripts from buyers at Famous Footwear, which is a very large wholesale chain. And all this is reflected in our estimates, which we believe eventually HeyDude's selling growth should asymptote to seller growth as we enter the second half of 2024. Our second point is we believe the CROX brand is under-penetrated across ex-US geographies. So when you look at the chart, you can clearly see that the international business in APAC and EMEA has been outperforming the North American business. And we believe that finally the turnaround in Asia, which has been a tough region for CROX, is finally been working in the past few quarters. On top of that, we think HeyDude international launch is still to come, which is an attractive opportunity to add about $700 million in incremental sales using the same US to international ratio as CROX. We think there is convexity in China for core CROX. So when you look at the incremental sales guide that was given by the management team, we think the incremental growth in China alone could be about 2/3 of the bridge to that 2024 guidance. And finally, we think the street is crediting the company with less than 25% of the international HeyDude opportunity, which implies that either the international business will not scale or the US can't support more than $1 billion in sales, both of which we disagree with.
So clearly, over a short period of time, CROX's margin profile has ballooned to over 25%, close to 30%, leaving a lot of investors skeptical about the sustainability of that trend. We believe investors more specifically are particularly uncomfortable with the cadence of that improvement, stepping from about 300 bips annually, historically, to over 700 bips through COVID annual improvement. However, we believe CROX was actually previously under-earning, just given sort of the low material costs in the COGS line, and as well as pure margins where they sit today. A deeper analysis decomposing the margin structure of the business leads us to believe that a lot of the recent acceleration is mostly ASP driven, concealing what's actually a 5-year plus long predictable algorithm of operating leverage and cost discipline on the fixed cost side. More specifically, we believe the business has actually also taken a significant amount of price, which has disproportionately benefited ASPs and margins, given the pricing flow through to margins. Also done a significant amount of web scraping to confirm this trend across the DTC channels, with CROX taking roughly 5 to 7% like-for-like pricing across all geographies. We've also seen a latent mix benefit from Jibbits, which are sort of the customizable attachments for CROX, which carry about a 90% gross margin profile. And we estimate 15 to 20% attach rates as sort of a conservative baseline assumption. On a go-forward basis, we see pricing as actually a sustainable lever for the business, given just where pricing stands today, especially in EMEA and APAC, and also given the mix of wholesale and international in the business, which obfuscates the list pricing and net pricing impact. So overall, we expect the forward-looking margin profile of the business to converge with the operating leverage improvement over the last couple of years. So given that a chunk of the aforementioned margin improvement has actually come as a byproduct of growth, we'd actually suggest shifting focus towards volumes. We believe that contrary to a lot of investor fears, material margin compression is extremely unlikely to occur in the absence of volumes collapsing. All in all, we believe CROX is a better business than it was pre-Andrew Reese and furthermore pre-COVID. Half the business is DTC and pricing is about 30 to 40% higher than it was pre-COVID. Furthermore, distribution is now controlled and inefficiencies that existed in prior booms and busts have been right-sized from a fixed cost perspective. Looking forward and actually benchmarking off the business's pre-pandemic volume cadence in North America, we believe North America, where the largest base of volumes stands today, can remain in a positive trend over our projection period, given that CROX has both found a replenishable base of demand and that we believe the revamped marketing strategy has been working quite well, being like a fast follower that latches onto up-and-coming pop culture trends. In the event of any downside, we'd point skeptics towards the international story, where about half the incremental unit growth will reside in on a go-forward basis. Additionally, upon further analysis of past volume booms, we believe candidly that a lot of other footwear brands present sort of a good comparison, with Uggs in particular showing an eerily similar story when its sheepskin boots pushed brand sales through the roof circa 2010, afterwards sales actually stabilized opposed to collapsing and continued to grow thereafter.
To better understand the market's current expectations for CROX, we conducted a reverse DCF, which revealed 3 key assumptions. First, the market expects volumes or ASPs to shrink. Second, it expects aggressive discounting. And third, it expects the recent operating leverage gains to reverse, all of which we disagree with given our previously mentioned thesis points. We also conducted a very simple back-of-the-envelope DCF, which finds a significant implied upside despite relatively conservative assumptions. Those three key assumptions being a 5% increase in price over time, in line with historical averages, volume growth that is slightly above pre-pandemic norms, and margins compressing slightly to 26%, which is in line with management's long-term commentary.
To get to our price targets, we are applying a 10x multiple on about $20 of forward EPS for our 1-year price target in January 2025. And we're applying a 10x multiple on about $25 of forward EPS for our 2-year price target in January 2026. As you can see in the red borders, we are not just betting on multiple expansion. We actually think CROX can do about $25 in adjusted EPS in 2026, which is about 70% higher than consensus.
We also support our valuation framework and sort of framing of the risk reward through analysis of several possible destination scenarios for both brands, which we believe highlights the asymmetry present in the setup. We believe the setup offers a line of sight towards an achievable 2 to 3x in 2 to 3 years, whilst offering significant downside protection. In other words, you have to really torture the destination assumptions to justify the current valuation. Mr. Market has clearly demonstrated a history of making some very peculiar calls on the CROX over the past few years, and we believe we're basically being offered a terrific, if not completely free lunch at free prices. On the most bearish downside scenarios, we assumed about a 20% sales drawdown and significant margin compression yielding 15 to 40% downside. On street estimates and more conservative base case assumptions, any reasonable multiple in earnings yields 2x or more upside. And then on the management case, with about $15 billion in CROX brand sales and margins sort of in line with where they are today, you can envision upwards of 5 to 6 times multiple invested capital. We believe the band of outcomes present here highlights the attractiveness of the setup to outperform major indices over a long-term period.
As far as risks and catalysts, we think the 3 main risks are going to be a global consumer slowdown, increasing competition in the footwear industry, which has always been intensive, and then finally, the risks inherent to the HeyDude integration. In terms of our catalyst plan, catalyst path and trading plan, we should continue to see outsized growth in the international business, especially in China. And we think there is actually upside to the management's targets for HeyDude in 2024. On top of that, we would like to see the management team start to buy back some of their stock with their about 15%. That's kind of like the total opportunity for the management team to buy back their stock. On a long-term basis, we should continue to see the US business to be stable and finally international growth. And on top of that, we should continue to see HeyDude grow at a more stable growth rates going forward. On top of that, we expect the management team to continue to use their considerable free cash flow to buy back their stock and continue to pay down their debt. I think that concludes our presentation. We can start answering some questions if you guys have any.
Just while you guys, great job, thank you. Love the graphic presentation, especially it's really simple and easy to follow. You guys talk about a share buyback as a significant driver of potential value. That that cash could be used to fund organic growth, or it could be used for M&A, or as a dividend to shareholders. Why do you think share buybacks is the right use of that cash?
Yeah, I can speak on that. I think the main reason is that we think the stock is cheap, right? It's trading at about 9-10 times, and historically the management team has been buying back stock at about in the high 80s, low 90s range. Now it's trading at about $100, so we could kind of think about a 10% downside case in that sense. So one is we believe the stock is cheap. Second, the management team, obviously they took on about $2.5 billion in that to buy HeyDude in 2022, and their goal was always to delever to less than 1.5 times, which they're basically doing in Q4. So once they get through that threshold, they should actually start buying back stock, which they said they would do. And I think it makes the most sense in this case, just given the multiple at which the stock is trading.
Yeah, and just to add on to that too, you mentioned like the organic growth piece, just reinvesting in the business. I think that's definitely actually more of an opportunity than a risk, just given, or maybe just it sort of adds some flexibility to the business, just given the fact that, as we mentioned earlier on, like about 2/3 of the incremental sales to bridge to next year's guide is effectively like coming from China, if you just assume like a 50% growth comp. And then the rest of that incremental sort of, we had spoken to some experts, some footwear experts, who suggested like just based from like a current sales efficiency perspective or sort of marketing efficiency perspective, they could just like buy that guide effectively. So there is actually sort of like, I think sort of a cushion from an organic perspective. They could choose to, instead of like buying back, putting 100% free cash flow to buybacks, they could effectively buy the bridge to the sales guide for next year. I don't think they would do that, of course, but it sort of has some flexibility for sure.
Awesome, thank you. One more for me. Looks like Blackstone made a big investment in within the last 5 years. Do you think Blackstone's been a value-added shareholder to this company in any way? You mentioned management, maybe anything else that Blackstone has done to help the company succeed?
Yeah, so I could start answering that, and then if anyone else has any additive points. But yeah, it was actually a pretty fundamental change in the business. So the management piece was huge. That's what we really tried to highlight. So we highlighted the CEO, which is obviously big change. CEO changes are generally very big, but like the other change that we didn't mention was, or at least didn't mention his name, was the CMO transition. His name's Terrence Riley. He was an incredible value add to the business, just in the marketing strategy. And we touched on this a little bit, but the big focus was shifting to this sort of idea of like active brand management, which wasn't really something at all the business had thought about or implemented prior to that period. It was really being the sort of fast follower. Instead of like creating your own trends or concepts, it was like being a fast follower onto whatever emerging trends there were. And the reason they can do that is because the core product, the core classic like clog product, is just like super malleable. Just its nature is super malleable. It's physically very malleable. Also perception wise it is, so you can basically like make a themed like CROX variant of like any upcoming like movie or pop culture trend or really anything. So malleable from those two perspectives. So that was what sort of elevated the brand perception from there, and it was also just like a key value add from Blackstone for sure. The other thing, and maybe the more quantifiable piece of that, was on the cost side. So to break it down a little bit further, was sort of rationalizing the SKU base. CROX was very disorganized with that just prior to that period. The number of SKUs came down considerably right after Blackstone invested, and then also the store base. So if you just kind of like look at what the sort of strategy and also the store count was like prior to 2014, it was like crazy. It was like something that a business of that size really shouldn't have had. It was like 300, 400 plus stores. And that has since come down like over like 50%. So they've really focused on that side of things. And then on the wholesale, they've really refocused a lot of the wholesale account base to maximize like not only the SKUs that are doing well, but just also like minimize discounting and also just like help the brand just retain tighter control on like what their pricing is, and have better communication with their better wholesale partners.
Awesome. Thank you.
I have a question. Do you think Crocs is really a marketing company that happens to have some sandals?
I think,
oh, go ahead, Ludo.
Yeah, like Tyson said, I think the marketing part of the story has been a key focus of the management team. And we believe that's really what's been driving kind of like all the demand for Crocs in the past few years, which is also kind of played into the strategy to kind of try to elevate the brand to a more kind of like stylish class, as opposed to just like a cheap plastic clog. And so when you think about the pricing for Crocs, like 5 to 6 years ago, the ASP for Crocs was like $35, and now they're basically selling them for $50, which kind of highlights that part of the strategy, which I think has been, like you said, like a result of the marketing strategy, which has been super important for the story.
Yeah, I thought they jumped the shark when they opened a store at Faneuil Hall. Did you ever go into that store?
I did not know.
Just one other question. This is kind of a Peter Lynch question. Have you walked a mile in a pair of Crocs? And I'm going to hold up my Birkin Crocs, which are plastic. Okay, check this out. These are plastic. They look like they're leather. They have a bed for your foot. I wouldn't hesitate to hike the Appalachian Trail in these. I don't think the Crocs could get me to the garbage can. So I'm just curious, did you look at the material, what they're producing compared to, the Birkin Crocs, which are pretty cool, by the way. I'm not trying to be a pigeon here. It's a fair question.
Yeah, I think Tyson is a big fan of one of the most recent models that Crocs started selling. I'm not sure, Tyson, if you bought the KFC ones or.
I didn't buy the KFC
How do they
ones.
taste? That's the question I had.
Yeah, they apparently smell like chicken, so maybe they taste good too. I don't know. I didn't buy those because those are like $300 on eBay or something crazy. But I did buy the Echo clogs, which are like supposed to be like kind of streetwear or something. But
you think they were trying to cash in on Air Jordan and things of that sort? The super cool sneakers.
I think so. It seems to be that kind of like fan base who wears them, so I'd probably think so. But
I think going off what you were saying about like the simple build, that's actually like a huge advantage for Crocs. When you look at the gross margins and the EBITDA margins for the business, it's much higher than all their footwear peers. And I think that plays a big role, just the fact that the plastic clog is so simple to make as opposed to like a more normal sneaker.
I'm sure everybody has about 6 pairs laying around.
Yeah.
Thank you. Very interesting.
Thank you.
Hey guys, really nice job. I think sort of highlighting the delta versus the street. I've rarely seen a 70% delta versus the street. So I think, if you're right, obviously the stock's gonna be huge. Just on that, like, I mean, the market's saying, look, this is sort of like a declining brand. It's going to struggle to protect its earnings power. And you guys are like, look, not only are you wrong, but actually we sort of see this as like a growth company.
And I don't think the bull on the street has a number anywhere close to $25 in earnings, right? So, incredible job if you're right. But just maybe like when you see an earnings delta that big, what is your source of variant perception, or what is the market getting so wrong here?
I think a key part of that is kind of like what we call like the customer investor mismatch, which is like the average guy on Wall Street does not like Crocs. Maybe they wear, fancier shoes, I guess. They do not like Crocs. They hate Hey Dude. When you look at Hey Dude and the Google trends for Hey Dude, they're super popular in the Midwest, but they still have not gotten to be as popular on the coasts. And so that customer investor mismatch, I think, is a key part of like why people tend to misunderstand the story. When you look at the numbers, Crocs has been growing insanely well in the past 6 to 7 years. And I think it's a type of sustainable growth. It's not just, something that happened during COVID, like Tyson said before. But I think that's a key part of like the misunderstanding. It's just like the average analyst on Wall Street does not like Crocs, does not wear Crocs. His friends do not wear Crocs. And so I think that mismatch is important in kind of understanding our variant perspective.
Yeah, and just to add to that, we think that the marketing element is a huge part of this. It's really easy to look at the Crocs brand as an investor, especially at first glance, and think it's just a really fatty kind of hot business now that will soon be on the decline. And especially if you look at these collaborations, like the KFC shoes, you think, that's kind of silly, that's fun, but it's just a blip, right? But we think that the new marketing strategy that began with Terrence Riley and now his successor as CMO, Haiti Cooley, have really mastered this strategy of catching emergent trends. So for example, Post Malone wore Crocs and it generated a ton of buzz online. Crocs capitalized immediately on that and collaborated with Post Malone. And we recognize that their marketing team is really masters of this strategy of marketing. We think it's sustainable and it's very calculated. It's not just a coincidence.
Yeah, and then to tag onto that too, just like from more quantitative element, like our delta to the street, it's really, I guess, like 2 or 3 pieces of that, but one of them is like the street's literally not modeling volume growth at all, which is kind of questionable, I would think. I think we have a few points on this, but mainly that they've definitely created this like much bigger base of demand in North America, at least than people think, and the street doesn't even split it out by geo effectively. But part of that is a lot of the people who wear Crocs are actually like not, you'd think of like the teens who were like post about them on social media, or like kids who wear them, or younger people, but a lot of people who wear Crocs are actually like food service workers, healthcare workers, and like basically everyone behind a Starbucks counter has Crocs. That's actually, we'd estimate to be around like 25-30%, just based on some surveys we've seen. That's like actually, I think, a surprisingly high percentage of the volume base. And then the other part of this is that like the unit growth, from a unit growth perspective, has been just off the charts, and like especially in APAC. And you could just even like, I think some analysts were trying to tell me like they were looking at like Google Trends, which is sort of questionable because like Google's like not really a thing in China. But if you look at like TikTok or something, like it's like the trends on TikTok are just like off the charts for Crocs, and it's like super recent too. But the brand even before this year was growing like 90%, and then comped that and grew another 90%. So clearly something's working very, very well just from the APAC side of things. And then we'd also argue sort of like that is actually furthermore just evidence that in a lot of these like geos, irrespective of the US, the like sort of popularity of the brand is actually just very insulated from that. Like it's not something that's just a something that's piggybacking off of like all the buzz from the US. It's like clearly in a lot of these countries, it's a very insulated event where it just becomes really popular, just given the local sort of localized marketing strategy. And when I say localized, it's because they like go to like the local celebrities or whatever is like locally trendy, and it's based off of that. It's not like they just copy whatever's in the US. So I think that's one piece of it. The pricing piece of it, we definitely model pricing in a more granular way. I don't think Street models price at all, but they model something in the low single digits for that. We think that's probably a good lever going forward, just given where Hey Dude ASPs are today, which are artificially suppressed because our point was that there's a big sort of a large amount of discounting on Amazon right now, which was when they basically bought Hey Dude and then they like cut out a bunch of retail wholesale partners. Those partners like dumped their stock in Hey Dude, and then a lot of them ended up on Amazon like heavily discounted. So that's kind of going to be something we'll effectively lap in the first half of this year.
And ASP should kind of come up because of that. And then also sort of for the core Crocs brand, we think they can sort of toggle forward about 3 to 5% price increases. And then especially in APAC, where pricing is just naturally a lot lower too. And then the last piece of it, I think on the EPS side, is just the buyback piece. For some reason, like I don't know why, but the street doesn't, at least the BOFA model I was looking at, just doesn't model any really any buybacks. Which I don't know where that free cash flow is going, but it's not going to buybacks. So that's actually a pretty big piece of the puzzle. Is like the management's been super committed to just plowing that back into buybacks on a go-forward basis. And I think a lot of the reason they've come out and said that and been really transparent about it is because there is so much angst around this HeyDude acquisition, and people are really questioning the capital allocation just going forward, given that it was such a chunky big deal. It was mostly debt finance. And it brought their leverage up to like 3.5 times. So I think it was really important for them to be really transparent about that. And that's obviously going to be a large source of upside just from a share count shrink perspective.
And then one last thing on that, on the top line versus the street, I think is like an important point. We spent quite a bit of time in the presentation talking about HeyDude. And obviously the street is looking at the surface level numbers for wholesale, and they're negative, right? The growth rates are negative. So some analysts are actually just like extrapolating that into the future, and they're basically saying, HeyDude, our bull case for HeyDude is that it's going to be flat. Instead, our numbers are actually taking a more nuanced view on the actual customer dollars that are being spent on the brand, which shows that it's going to continue. And so I'm looking at the sell side numbers here, like they have HeyDude grow like low single digit in 2025, which I think is very conservative. So that's a key part of like our variance view on top line.
Yeah, really great answers. Just one final one. I know we're nearly at time. So I guess the question would be like, if I was a cynic, right, looking at this, and I would say, all right, you got incredible organic momentum, margins are going up, DTC is working, you're getting kind of, local sort of brand influence. Why would they go and buy this complicated, messy brand and mess up the equity story and make it so difficult? Like if there's so much going on that's positive organically, why do this deal?
Yeah, I can start with. Oh, go ahead, Pedro.
Yeah, Tyson, go ahead.
Okay, yeah, I'll just start with that. It's a really great question. One we've dug into quite a bit. Just given, well, first of all, first principles, look at the multiples like 7 times earnings. So clearly people don't love the capital allocation strategy, and obviously at a low multiple, the capital allocation is going to matter a lot more. People often get it wrong. It's like it actually matters more at a lower multiple, not a higher multiple. Yeah, so why would they buy HeyDude? I think, anyone can speculate about this. I think a few reasons. It really falls in line with sort of the comfort and personalization trend, and which we believe is definitely something that's like secular. It's not some like fatty type of thing, but it's like sort of like Crocs. HeyDude is comfortable. It's well suited to the casualized world, like the loafers, and furthermore, like the loafers as a silhouette are just well suited to a much wider range of occasions than simple plaster Crocs would be. And it's also been something that's just become more socially acceptable or in public. So I think it really does fall into the product category, just given the sort of casualized like personalization trend. Now the question like why they would buy it is interesting. It's really anyone's guess, and it's obviously caused a lot of angst on the street. So we haven't really speculated about what like sort of the reasoning was, and candidly going forward, we would prefer the business not to go and like let's say HeyDude works really well, and then they decide to go buy another like HeyDude like brand. We'd probably not like that very much. We'd probably rather them just buy back shares of stock, and I think they've realized some of their faults and like maybe potentially overpaying, like they paid like 15 times EBITDA, so they paid over like the current Crocs in isolation multiple. They've kind of learned to be a little bit more disciplined on that side. Yeah, I think it's, there's a lot of speculation about why they bought it, but I think it really does fit into sort of the trend that the core product class of Crocs is in.
One thing that I wanted to add on that, I think like a key part of the bear case for Crocs historically has been that it's a mono-product company. And so I think that's also part of the reason why the stock has been trading at such a low multiple compared to their footwear peers. And so I can imagine that, a CEO could think, okay, like how do we maximize the value of this business, of the core franchise, we might go out and make an acquisition to try to diversify kind of the brand base, and maybe that will help us, you know, will help us kind of like get rid of that bear case that is like, okay, they only have one product. If the core CROX, you know, stops growing or shrinks, basically the entire company is done. While here they diversified the brand base, and I think that's part of the reason why they probably did that. But it's just a guess. Sorry, it's just a guess, and I'm kind of just just thinking about it.
And to take the less cynical view, actually, like the more optimistic view is like just looking at their track record, right? They obviously have an incredible track record on the marketing side of things. Why not just buy like some other footwear company that's like less than $1 billion sales at the time they bought it, and you know, try to apply the strategy that we know is, you know, tried and tested, and see if we can grow it not only, you know, from $1 billion base in the US, but also plug it into our existing GTM channels in you know, Italy and the UK and France and a bunch of other countries where we think, you know, the product silhouette's actually super similar to CROX, and the customer base, the end markets are very similar. Like, why not try to do that? And so like from that perspective, it actually could, you know, inversely work actually pretty well. You know, we had like a case where like if they just plugged it into their existing channels, that's like 700 million in incremental sales like that, like sell in. So that could be a reason.
All right. I hate to interrupt this discussion, but we are about out of time, and I don't want to hold everyone here forever. But really appreciated the CROX team for the presentation, and best of luck.
Thanks for all your efforts.
Thank you.
Thank you.
Thank you for having us.
Thanks, guys.
Good job, yeah.
All right. Thank you, judges, for coming on this Saturday. Appreciate all the support, and hope, you know, we can continue this in the future. Really appreciate everything.
I actually really enjoyed this, so it was a good use of a Saturday afternoon.
I'm glad. And, you know, we hope to see you at DIPP in the future as well, Dave.
Well, I hope to come by and maybe help you raise some money.
Rebecca, Pranay, would love to see you sometime up in Hanover. Really appreciate everything as well.
You guys did an awesome job. It's great to see like international participation, and this was just so well run. So thanks for inviting us.
Yeah, incredible job. Thanks, guys. Good work.
All right. Have a great rest of your weekend, everyone. Goodbye.
Bye.